Welcome to our video on the topic of active versus passive investing. Investing can be a great way to grow your wealth, but with so many options available, it can be difficult to know where to start. In this video, we will be exploring the differences between active and passive investing, and help you determine which approach may be right for you. Active investing involves making individual decisions about what stocks to buy and sell with the aim to beat the market. On the other hand, passive investing involves investing in a diversified portfolio that tracks a market index, with the goal of matching the market's performance over time. Whether you are new to investing or a seasoned pro, this video will provide you with valuable insight to help you make informed decisions about your investments. If you like this content, please remember to hit the like button and subscribe. Let's get started. An active investing strategy is one where the investor takes a hands-on approach that involves research and analysis as well as monitoring the prices of stocks to find buying and selling opportunities. The goal is to build a portfolio that will outperform a selected benchmark. A benchmark is a standard or reference point used to measure the performance of an investment portfolio. It is usually a broad-based index such as the S&P 500. It is used to gauge how well an investor's portfolio is performing relative to the market. Active investing allows more control over your investment choices and the potential for higher returns, and thus the ability to beat the market. However, active investing generally involves higher fees, as active management typically involves paying for professional investment management services. Additionally, there is timing and selection risk involved in active investing, as even the best investors can make mistakes or miss out on opportunities. Passive investing, on the other hand, involves little to no research or analysis of individual companies. Instead, investors focus on spreading their money across a large number of stocks or to gain exposure to the stock market as a whole. In this way, passive investing doesn't look to beat the benchmark, but instead to mimic it. There are different approaches to passive investing, but index investing is one of the most popular applications. Index investing involves buying funds that replicate an index such as the S&P 500. It can be argued that a passive investing strategy is better suited for newer and time-poor investors, as it is consistent with a long-term view, has lower fees, and avoids the timing and selection risks associated with active investing. The main disadvantage with passive investing is the limited control over investments, as the portfolio is automatically managed to match the market. Passive investors are usually advocates of the efficient market hypothesis, which is a theory that states that financial markets are always perfectly efficient, and that it is impossible for investors to consistently achieve returns above the market average. According to the efficient market hypothesis, all publicly available information about a company or the market is already reflected in its stock price, making it impossible for active investors to outperform the market in the long run. As a result, passive investing is seen as a logical investment strategy for those who believe in the efficient market hypothesis, as it simply involves investing in a low-cost diversified portfolio that tracks the market rather than trying to beat it. Passive investing is often seen as a more efficient investment strategy compared to active investing, as it tends to have lower costs and a lower degree of risk. By investing in a broad market index, passive investors are able to take advantage of market-wide trends, rather than trying to pick individual stocks that may or may not outperform the market. In short, passive investing and the efficient market hypothesis are closely related, as the idea behind passive investing is that it is impossible to outperform the market, and therefore the best way to achieve market average returns is through a low-cost, passively managed portfolio. On the other hand, active investors don't believe that markets are completely efficient. Instead, they believe that a stock's price can often deviate from what it's actually worth, and that by carrying out research and analysis, one can identify and profit from these opportunities. One of the tenets of this belief is investor irrationality, whereas the efficient market hypothesis assumes that all investors are rational. Active investors believe that market participants frequently exhibit irrational behavior with behavioral biases, sometimes defying logic. An opportunity for active investors may come from exploiting the investment mandate of large funds. Due to the recent explosion and growth of index funds and exchange-traded funds or ETFs, when stock markets are experiencing growth, investors are generally more confident and put more money into stocks via these investment vehicles. Since they are generally open-ended funds, more and more money flows into the market. As the fund mandate is to replicate the stock market as a whole, relatively more money flows into stocks with larger market capitalizations. This supply and demand dynamic will put upwards pressure on the stock prices of the largest companies. Of course, the reverse is also true. When stock markets are experiencing negative growth, investors become less confident and move their money out of stocks into safer asset classes such as cash. As funds flow in and out of the funds, buying and selling pressure can radically move the price of stocks that form part of the indices, even though the intrinsic value of individual companies may not have changed, thus creating buying and selling opportunities for active investors. Further, it is well known that as a company grows, it becomes progressively more difficult to continue to grow at a fast pace, and its growth will over time trend towards that of the economy as a whole. As passive investors prioritize companies with large market capitalizations, more of their funds may be going into stocks with deteriorating growth prospects. It can also be argued since a lot of new technologies are initially created by new and smaller companies, passive investors can miss out on the growth of these new technologies until after they've experienced huge growth, and the companies that own these technologies become large enough to enter the most popular indices. Overall, active investing is a good choice for those who are comfortable taking a hands-on approach to investing and are willing to pay for professional investment management services. Whilst passive investing is a good choice for those who prefer a hands-off approach to investing, and for those who are looking for a low-cost and straightforward investment strategy. So far, we have looked at active versus passive investing strategies as discrete one or the other strategies. But the truth is that active and passive investing exists on a spectrum. At the one end, you have extreme active investors who day trade and watch markets 24/7. And on the other end, you have passive investors who only invest in broad-based index funds. For most investors, combining elements of both strategies is a more appropriate investment strategy. Personally, I would consider myself as an active investor as I research and choose my own stocks. However, I incorporate elements of passive investing as I build a broad portfolio of 20 to 30 stocks and generally hold positions for the long term regardless of daily fluctuations. Regardless of where you fall on the spectrum, there are still lessons you can take from both approaches that will help you become a better investor. In fact, holding as little as 15 to 20 stocks in a portfolio can produce a return profile similar to the market as a whole, while still providing the flexibility to invest in companies that are believed to outperform the market. A hybrid approach may involve investing in a combination of actively managed and passively managed funds, with the goal of finding a balance between the two styles. For example, you might allocate a portion of your portfolio to a passively managed index fund, while also investing in actively managed funds that have a good track record of outperforming the market. Overall, a hybrid approach to investing can be a good choice for those who are seeking a balance between active and passive investing, and who are comfortable with a mix of both hands-on and hands-off investing. In conclusion, choosing between active and passive investing, or opting for a hybrid approach, is a personal decision that will depend on your individual investment goals, time horizon, risk tolerance, and budget. Both active and passive investing have their own advantages and disadvantages, and a hybrid approach combines elements of both. Thank you for watching this video on active versus passive investing. We hope that this has provided you with a deeper understanding of these two approaches and has helped you make an informed decision about which strategy may be best for you. If you have any further questions or would like to learn more, please feel free to leave a comment below. Don't forget to like and subscribe to our channel for more educational content like this. Until next time, happy investing.